Welcome back to EDS, and in this video I'm going to show you step by step how to get a high return on capital even if you have a small account. So the first thing you want to do is open up your brokerage platform, and you want to go over to where you can see your watch list. I'm going to use a pre-made futures watch list. Futures is what we're going to be using. That's the instrument that we're going to be using. And futures is very capital efficient. We're going to be writing options contracts on futures contracts. Okay, so you want to pull up a watch list where you can see a list of futures with options specifically. Now what you want to do is you want to order everything from high to low IV rank. Now normally we would be filtering out for earnings and things like that, but you don't really need to do that. If you really wanted to filter anything, just filter out anything with a low liquidity rating level, but all futures are pretty liquid anyway, so you wouldn't really need to do that. So you want to order everything from high to low IV rank, and you simply want to go down the list and see what would fit well in your portfolio. Now we're going to be focusing on the British pound futures because it's got an IV rank of 79.6 at the moment. Now that's quite high. It has an absolute IV level of 11.4%. So what we want to do is now open up a list of expiration dates for the British pound futures, and we want to pick an expiration date that's between 30 and 60 days out in time. Now we've got the March 7th expiration date that expires in 57 days time, so we're just going to open up the options chain for March 7th, and now we're going to do what we normally do, which is just simply sell one call and one put, and you'll begin to see how capital efficiency comes into this. And we're going to go over exactly how you can get a higher return on capital with futures as opposed to with equities. So we've got this orange horizontal line that shows us the price of the British pound futures with respect to the strikes. We have this vertical orange bar that shows us what the expected move is of the British pound futures, and we're simply just going to do what we always do. We're going to sell one call and one put, and we want to be around the 15 to 20 delta mark. We've got a 20 delta here at the 1.27 strike, and we've got a 20 delta here at the 1.185 strike. So as you can see, just so we can get this green bar up, as you can see, we've sold a call and a put outside of the expected move, and we have a nice green break-even bar that overshadows the expected move bar, and that's going to give us a high probability of success. Now if you look in the bottom left corner, we have a pop of 68%. Our P50 isn't calculated with futures on this platform, but we have a pop of 68%, which is pretty standard so far. Same thing as with equities, you'll always typically end up around about 65-70% pop if you go with a 20 delta on either side. But the main thing here is we have a max profit of 700. Now this is 0.0112 cents per contract. The contract multipliers in the hundreds of thousands. I'm not sure specifically what it is for the British pound futures off the top of my head, but it is in the hundreds of thousands, which is why this number looks weird. But basically we have a max profit of $700. We will collect $700 up front. Now the important thing to note here is our buying power requirement is $965. So we're going to collect 700, and our broker is going to hold 965 in buying power. Now for anyone that's seen our previous videos, this return on capital here is very, very high in comparison to equity. Is very high, full stop. But compared to equities, which is what we normally write contracts on, this is why futures is powerful. This is why futures should have a place in your portfolio. It is extremely capital efficient. We are getting a very high return on capital here. You just need to remember that futures is obviously, specifically with the British pound, for example, it's a much bigger product than with a standard equity that you might trade. So what you can do is you can also turn this into a defined risk position, and you can simply just buy another contract a little bit further out of the money. And what you're going to be able to do here is limit your max loss. you're going to reduce your buying power requirement, say in this instance $114, and we have a max profit of $112. So you're basically getting almost a 100% return on capital here, which is exceptionally good. Now, you can play with this a little bit more. You can make this a little bit wider, increase your buying power requirement, increase your max profit. There's lots of different ways that you can play with this. This is probably the more suitable position. This is probably more what I would look to place in this portfolio. But as you can see, futures is extremely capital efficient, and that's the main thing that I wanted to show you. You trade the position the same way as with equities. Everything is the same. The mechanics are the same. Everything is the same. It's just that with futures, the way that the margin requirement is calculated is different. It uses what's called span margin, and by all means you can look that up and see what that entails. But basically, the way that the margin is calculated is different, and we end up with a much more capital efficient situation. So with that being said, how do you know how much buying power to be allocating to your positions? Well, we have a position sizing template here that's free for everybody to use. Link is in the description. Just click the button here and it will take you over to this position sizing template. And the way it works is you enter in the size of your portfolio. You then enter in whatever the current VIX level is, and then everything will then be automatically calculated for you. All you need to do is use this information to form the backbone of your portfolio. It will tell you the maximum amount of buying power to allocate to a single defined risk position, undefined risk position, how much of your portfolio you should be allocating to short premium strategies in general. And over the long run, as long as you follow this, you'll be absolutely fine. This also applies to futures as well as equities. If you want to learn in more detail about what we do and how we do it, click on EDS Premium. The link will be in the description, and get yourself signed up. Inside, you'll have access to our portfolios that will allow you to see the positions that we're placing, how we're managing risk, how we're making adjustments, all in real time. There's also a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. And if you get stuck, you can speak with myself directly or with other like-minded individuals. There's a 100% money back guarantee. So once you have studied the full course for at least 6 months and followed some of our trades, if at that point you haven't been profitable, then we will work with you for free until you are. Or you can simply request a full refund. So it's completely risk-free on your part. And right now it's £1 a month to join. The price will be increasing. It's so cheap because we've just launched. So you are rewarded for getting in early. And the aim of EDS Premium is to get you to a point where you've learned the skill, you know how to write contracts, you know how to manage risk, you know how to make adjustments. And it's something that no one can take away from you for the rest of your life. And we aim to get you to the point where you've learned that skill and ability within 6 to 12 months. You're always welcome to stay and be a part of the community. However, 6 to 12 months and you should be good to go. So with that being said, I will see you guys on the inside.